Hello and welcome. It's indeed the big policy day tomorrow, as the spotlight will be on RBI Governor Rajiv Patel and his team as he delivers the first monetary statement of fiscal year 18. The markets have factored in a status quo at the Monetary Policy Committee as investors don't expect any surprises come tomorrow. So which way will Dr. Patel swing? Is liquidity management really going to be the big driver? Have inflation concerns ebbed or have they actually risen? For all of that and more, our expert panel joins us right here on ET Now. Thank you each one of you for being with us. Mythili Bhusnurmath, our consulting editor, Dr. Rajiv Kumar, senior fellow CPR, and of course, member of Bank of India board, former chief economic advisor Arvind Virmani, and Jahangir Aziz joins us as well, director JP Morgan. Thanks each one of you for being with us. And Mythili, let me begin with you. The last time RBI announced a policy, they did change the stance from accommodative to neutral, citing inflation concerns, the upside risk that affects inflation. So I'm going to really divide this show into two parts. We'll discuss the macro and the inflation at one time, and we're going to discuss liquidity at the other. From the last time we spoke on RBI policy, which was in February, to now, do you believe inflationary concerns have risen or have they actually subsided?
Well, when talks of inflation, Supriya, it really depends on what inflation one's talking about. Because wholesale price inflation has definitely gone up. CPI has kind of gone up very marginally. It's more or less within the band, less than 4%. So depending on what the RBI wants to look at, it could interpret either way. Of course, officially they say they're looking only at CPI. By that logic, they're well within that 4% target in for March 2018. So there's really no need for them to worry. But a lot, as I said, will depend on what the RBI's view of that surplus liquidity is, because remember, RBI's job is basically to manage the liquidity. So if they are managing the liquidity well, which they clearly are not, then they should be doing something about it, because that is the problem. There is so much of liquidity, and the RBI will really need to determine, is this liquidity a structural excess? Is it a temporary excess? If so, for how long is it excess? How much of it is excess? So they have to take a number of decisions, but unfortunately in the macro economy, none of these decisions is very easy at all. So my sympathies, as always, are with the Reserve Bank of India governor and also with the MPC, because it's going to be very difficult to call, and if you call wrong, the brickbats are very quick in coming.
Okay, so I mean, I do know that the large focus of this discussion and the show today has to be liquidity. What should the RBI do? Should they signal that, because in terms of policy stance, liquidity conditions and policy stance is at variance. The policy stance is neutral and liquidity is in excess. But I'm going to talk to you about that in just a bit. I do want to get inflation out of the way for now. Dr. Rajiv Kumar, since we last spoke on policy, which was February 7th, if I'm not wrong, yes indeed, what has happened to inflation? Have concerns risen around inflation or have they actually subsided? Because the global situation is looking a lot better. Crude oil prices that were supposed to be an upside risk to inflation have indeed subsided. Global growth is picking up, but domestic factors continue to be at variance. What's your overall take on inflation to begin with?
But, you know, to me it's very clear, Supriya, that the inflation expectations have subsided. I mean, the CPI is in February 3.65, between January to 3.15. I think the March CPI would also come in well below 4. You know, and let's accept that the RBI's mandated target is 4% plus minus 2. So I mean there is in my, I can't see with the oil prices also declining, food prices not showing a pickup. You know, they have 2% inflation last time. It was, I know, 0.53. And let's not confuse issues. I mean, the RBI is mandated to look at CPI. If they look at WPI, they are not going to be doing what they're expected to do. So in all of this, I can't see how inflation expectations are, the risk is on the upside at all. So to that extent, I think RBI should, and they said that they expected, inflation to be at 5% by the end of March. It's well below that. So in that sense, I think what they said in December, they should go back to that and say, well, our forecasts have been, much higher. The reality is much better. So we should, when facts change, intelligent people change their views as well.
valid argument that intelligent people should be changing with changing facts. But Dr. Arvind Virmani, do you agree with Dr. Rajiv Kumar that risks to inflation have actually gone down instead of going up? Because there are reports out there and there are economists and experts out there who have said that cost push inflation is a big factor. It is a big point of concern. They've also said that concerns around the GST, which is the big elephant in the room, also exist. They have said that food prices continue to be a concern. The domestic factors for inflation seem to be intact, even though the international and the global factors have been taken care of, and much to our advantage.
So, a couple of points. One, as far as I am concerned, the inflation is on a downtrend and on track with what I've been saying for the last 18 months on record. That is, I gave a probability of 65% for inflation between 4 and 5% at end March, and probably the only person at that time, 12 months ago, I said that it could be 15 to 20% probability of it being less than 4%. That's where it seems to be coming. Number two, as far as the RBI's statement of inflation in the last policy was concerned, I think some of the things they predicted have not come true, as Rajiv quite correctly pointed out. Of course, I didn't personally expect, but if they expected, they have not been confirmed by them. Number three, the issue of WPI globally or PPI equivalent across the world is only relevant if there is a model or a assumption that higher PPP will feed into higher CPI. But we know that in India, for the last 3 years, the connection between WPI and CPI has been completely broken, and the gap had widened. Now it is beginning to close. So there is no question of there being a direct positive correlation between the two, at least for some time, till the WPI CPI catches up. And one of the reasons for that is that it's really going to, the fact which has been noted many times, that demand and capacity utilization is low, is part of the reason why this link has been broken. So even if WPI rises, it is not going to translate, it's going to change profits, but not necessarily translate directly into consumer prices. So these are my 3 main points. Sorry, you had one more question?
No, I'm going to just take that question up right next, but I do want to quickly pick Mythili's brain on this. And Mythili, you started off with talking about liquidity, and I'm going to address that. I promise I will. But before that, actually, let me just get in Jahangir Aziz. And Jahangir, the RBI had mentioned that the key risks to inflation are weak rupee, oil prices, pay commission impact. Where are you on all of these factors and its impact perhaps on inflation? Upside risks have eased, or have they actually gone up?
Look, I mean, if inflation is being driven by actual increase in demand, it should show up in core inflation. What we have seen in core inflation, once we have taken out the impact of diesel and petroleum and transport prices, is that core inflation has actually fallen over the last 6-7 months' time almost by 100 basis points, from around a very sticky 5.5 to a slow drip towards 4.5%. That's a sign that there isn't very much demand in the economy. And I would say that till that number starts moving up and moving up quite aggressively, changing the stance of monetary policy or reacting to things like one-off measures like the 7th pay commission effect, or a jump in inflation rate or a jump in oil prices, I don't think monetary policy should react, and I don't think the RBI is going to react to it. RBI has in the past and will continue to look past this and see whether or not there is a genuine inflection in demand-driven inflation before it changes its stance.
All right, fair point indeed. But let's just talk about liquidity right now. And Mythili, you started speaking about liquidity, so I'm going to begin. Okay, Dr. Kumar, you want to make a point there? Please come in.
Yeah, I just want to make the sort of just substantiate what Jahangir was saying, which is that yes, because the core inflation has gone down 100% and all the expectations of domestic demand are not on the upside, I think isn't it time for RBI therefore to say that, to go back to saying that look, the risks are not on the upside, and because the risks are not on the upside, therefore they should go back, they should revert back to their December 8 situation of equally weighting the two risks. And if in my view, because you are below the mandated 4% by a significant margin, I think there is room now here for some policy action.
Dr. Arvind Virmani, I'm going to get you in on this. Do you really believe there is scope and room for policy action? And by policy action, I'm presuming Dr. Kumar is obviously hinting at a rate cut. And here, the RBI has changed its stance and preparing ground for a rate hike if and when warranted. Mythili, I'm coming to you next.
See, I had said after the last monetary policy, two things which I think are still relevant. One, I said in the next 12 months, the danger I see is of appreciation, real effective appreciation of the rupee, not a depreciation. And the reason was that with a tight monetary policy, there was a likelihood which has come true of a substantially increased amount of capital inflows. Of course, I should add that it was not purely my economic analysis, but the political fact of the UP election which accelerated this inflow. But the overall economic impact still remains. Over the next 12 months, I expect that there will be a substantial appreciation of the real effective exchange rate of the rupee if the monetary policy stance is not changed according to in the direction that I have been recommending. So there is a real problem there, but I don't think the RBI is going to reconsider this time, because they just changed the approach and tightened it last time. I think it's very, very unlikely that they will fluctuate again unless they go back to the original one. What is the original? This is the first time in the last policy they started talking about core inflation. Before that, at least for the couple of years I was associated, they had never talked about that. It is one thing to say how core inflation will feed into the overall inflation, or how WPI will feed into the overall inflation. But the whole policy stance was that in India, because food inflation is such a large part of the common consumer basket, we can't ignore it. So we have to focus on total CPI inflation, not just core inflation. But the last time they seem to be changing that approach. So unless they go back to the old approach, I do not expect a reduction in that interest rate, in the repo rates.
Okay, I get the point. Mythili, you want to quickly add on to that, because I do want to now move to liquidity very quickly. You want to add on to that point before I move on?
Yeah, I just wanted to kind of disagree with Rajiv in the sense that you cannot possibly have an accommodative stance and excess liquidity. The two cannot coexist, that is one. Number two, even though consumer price inflation is down, there is a huge debate on which the jury is still out on whether central banks should respond to asset price inflation. And what we are seeing, particularly if you look at the capital markets, there is huge asset price inflation. Now, should central banks respond to that? The jury is still out on that. What do central banks look at? Only consumer price inflation or asset price inflation? So while I would say there is no case whatsoever for you to change your stance or to cut rates, I think one has to be a little wary going forward.
Jahangir, 3 next.
Supriya, hello, Supriya.
All right, let's just shift focus and talk about. Yes, come in, Dr. Kumar. Sure.
But this asset price inflation is only about the stock prices.
Come in, Dr. Kumar.
The real estate is down. I'm saying that Mythili talked about the asset price inflation. That's only in the stock market. The real estate prices are down. As far as I can make out, the other assets are also not. There is no inflation or danger of a bubble. And this thing about liquidity and price cut, etc. I mean, after all, the banks are themselves cutting. They are in some sense leading the RBI by cutting their rates at the moment, as announced by SBI the other day. And to say that liquidity is a problem in the face of a stagnant or weak demand, I cannot see what does liquidity do. I mean, liquidity, if there is excess liquidity, it must feed into demand, which it is not doing. So therefore, the logical reason for RBI to act upon liquidity, excess liquidity, I don't see exists. The core inflation is where it is. It's declining. It's weakening. And so therefore there is a weakness in demand which RBI must take cognizance of. I mean, we are not into a dogmatic situation here.
That's a valid point indeed, that demand hasn't picked up and the RBI needs to take cognizance of that. But Mythili, let me throw this to you because, liquidity is at variance with the stance. I agree with that. The stance is neutral, liquidity is excess. But a lot of that excess liquidity has to do with the fact that there is excess cash in the system and cash withdrawal limits have just been eased. These are behavioral issues. We still do not know how it's going to really pan out. So don't you believe that the RBI needs to let liquidity stay where it is, simply because it will be very risky to tweak it at this point in time, even though it may be at variance? Live with it.
Well, it depends on the quantum. Given the kind of excess liquidity, 4 trillion that is the estimate, that is a huge amount of excess. And the fact is that remonetization has supposedly happened. And the argument that you need that liquidity because demand is not picking up, let us be very clear, demand is not just a function of interest rates or the availability of liquidity. Demand is a function of many other things. Until such times as those other things change, you will not find that liquidity alone can drive demand. So RBI necessarily has to, as the central bank in charge of liquidity management, ensure that there is just sufficient liquidity to oil the wheels of the economy, not so much that can at any point of time lead to certain damaging conclusions.
Like what?
I'm just going to get Jahangir Aziz into this. And Jahangir, how do you see the RBI manage excess liquidity? There are quarters. I'll come to you. I'll come to you, Dr. Kumar, because Jahangir, there are quarters that have suggested perhaps there's a case of a CRR hike, but our panel here is divided. Dr. Kumar believes that, liquidity is not such a big concern because demand has picked up. Mythili believes liquidity just needs to oil the demand scenario. Let me get you on this. How do you see the RBI manage the excess liquidity scenario right now? If there is excess, that is.
Look, I mean, most of the excess liquidity that you see in the system was a result of demonetization and people depositing cash. Now, as the cash rolls out of the system, that excess liquidity will once again subside. I think the RBI needs to give a little more time for the market to do that. It needs to have a little bit more patience. Managing excess, unless the excess liquidity is filling itself or finding its way into, let's say, asset markets and is threatening financial instability, which it isn't at this point in time, I really don't think that any drastic measure in culling liquidity is needed. I think a little bit more patience is needed from the RBI rather than taking any drastic, large steps to mop up liquidity at this point.
Dr. Arvind Virmani, I want to ask you this question. What should the RBI be doing? Our panel is strictly divided into the liquidity situation. There is excess liquidity, perhaps on account of the cash withdrawal limits that have just been hiked. One does not know what the impact will be. I want to talk about the standing deposit facility and all of that in just a bit. But should the RBI at all focus on sucking out or draining liquidity from the system, or should it wait and watch, even though it may be at variance with its own policy stance?
Right. So what it should do depends on our analysis of why it's happening. I agree that with Jahangir that one part of it is probably the deposit situation. The cash was put in, withdrawn, etc. That is probably not played out fully. So I think it's partly that, but I don't think it's fully that. And that has connected with my earlier analysis, what I was talking about, that the tight monetary policy is now attracting large amounts of foreign capital inflows, and that will increase liquidity. I have seen this many times in the past, and I have dealt with it from the finance ministry side, not the RBI side, of course. And so there is an issue will arise pretty soon. Maybe not, it's not there immediately. So I expect that the RBI will try to put in place mechanisms. If there is a danger of the RBI running out of government securities for repo, reverse repo type of purposes, then this facility which people are talking about, you said we'll discuss it further, does make sense to me, to give flexibility to the banks to be able to move in and out depending on the demand. So that introduction of such a facility would not surprise me.
Okay, it's not going to surprise you, but Dr. Rajiv Kumar, I know you want to make a point, so I'll let you make that point, but I also have a question. The standing deposit facility that has been spoken of, the other debate around the SDF, of course, and the government will have to chip in because the RBI Act needs to be amended to have that. But I think the other part to look into this, at what rate? Should the rates be higher? Should the rates be lower? How much cognizance should be paid to banks because they're going to be saddled with losses? So I'm just trying to pick your brains specifically on the standing deposit facility, but you can make your point before we go ahead any further.
Yeah. I wanted to make the point in the liquidity, which is, that for this liquidity which is parked, whatsoever amount it is, 4 trillion or whatever, which is parked at the moment in commercial bank deposits, for it to move into any asset classes is going to be very, very difficult because of the whole political economy, tax, black money, operations against black money situations, etc. So I'm thinking everybody who owns this, liquidity will be very wary of moving them into any asset classes or particular either investment demand or huge consumption demand, because that is where they fear the ED's, the taxman's eyes will be. So I think that this liquidity is there to stay with the banks, and we should allow the banks to do whatever they are actually already doing. In fact, to encourage them to bring down the rates, therefore, so that the demand in the economy can pick up. On the second issue about what Arvind has been saying about the attracting all the capital, and all the earlier arguments about the taper tantrums and the Fed raising rates, and therefore there is a vulnerability on the Indian rupee, have all proven to be wrong. So at this point of time, if you raise interest rates or you keep a tight monetary stance, you will only worsen the situation, arising to the point of now, very soon you will start talking about the Tobin taxes, etc., to stem the flow of foreign capital. So I think what Jahangir says about being patient at this point of time, and in fact what I am saying is that not just being patient, but to change your stance at this point of time would be quite an order. On the standing deposit facility, I think again, I don't think any change is required at this point of time, because this is a time where I'm not sure whether the central bank has enough data for it to be able to act on on influencing any decision by the commercial banks or by the capital market operators. I would just stay put on that and not raise it and not tamper it and not tweak it in any way.
Okay, you want to stay put, not tweak it in any way, because you don't believe that liquidity is too excess in the system and perhaps demand hasn't picked up. I get your point there, but Jahangir, you want to come in on that, because there's been so much written and said about the standing deposit facility. I can't not ask you the question that if indeed it is announced, so of course the other debate is on rates. Should it be higher? Should it be lower? But what would its impact on liquidity really be, on interest rates, on banks?
Look, I mean, it will depend on exactly what the standing facility is going to be and what the interest rate on the standing facility is going to be. Clearly, if the RBI wants to mop up liquidity with a standing facility where the standing facility has mandatory elements in it and the interest rate paid on that standing facility is lower than the repo rate, it is going to hurt the banks. But again, do we need a standing facility at this point in time? I know there are issues related to whether RBI can have such a standing facility where it actually buys up assets from the banks on a mandatory basis. Again, as I said, I mean, I think I would rather have RBI show a little bit more patience at this point in time. The excess liquidity in the system isn't at this juncture feeding into either inflation, goods inflation, or feeding into any kind of exuberant price movement on the asset market. So yes, the RBI could come up with a standing facility. The details of the standing facility will become important. But at this juncture, I would say that it is probably wiser for the RBI to wait a few more months than to jump into a standing facility at this point.
Mythili, while I appreciate the point that you made early on that, credit growth, which is at a historic low of 4%, is not a function just of monetary policy rates, but I do want to ask you the question on standing deposit facility. If it were to be introduced, higher rates is going to benefit banks. Where do you see the RBI throw its weight behind? Should the rates be higher or should the rates be lower? Because that's the other part of the debate that's doing the rounds on SDF.
See, Supriya, to the extent that a neutral stance is completely in conflict with surplus liquidity, and everybody accepts that there is surplus liquidity of a huge order. So there is a complete disconnect between your stance and the ground level reality. That is number one. Number two, even though there has been so much discussion about a SDF, a standing deposit facility, the fact is that the RBI has used something very similar. The market stabilization bonds during the time when Dr. Reddy was in office and there was a huge influx of foreign exchange. At that time also the RBI did use some facility as the MSS to withdraw this liquidity. And now the only difference really between the SDF, which the Ujit Patel committee recommended, and the MSS is that under the MSS the interest rate is borne by the government. Under the SDF the interest rate will be borne by the Reserve Bank of India. But in practice and in substance they are both exactly the same. So if an SDF requires an amendment to the RBI Act, and we have used MSS in the past, I don't see any reason why we cannot use MSS again. So there are techniques, there are ways, and nobody is suggesting that the RBI drains out all the excess liquidity in one fell swoop. What they should do, and any central bank should do, is drain it gradually, because after all this is something that nobody has a complete fix on. It is not like an equation. So they'll have to move very slowly, very cautiously, and feel the stones, as it were, while crossing the river, drain the liquidity slowly but surely to bring the stance and the ground reality in consonance with each other.
A last word then to Dr. Rajiv Kumar. And Dr. Kumar, very quickly, I want to come in on the growth aspect. Where do you see the RBI commentary there? Should RBI be at all referring to exports that have picked up? Should it all be referring to some of the structural changes that we've seen in exports, like steel exports and all that have gone up? Or should the RBI just keep its focus primarily on liquidity management and, of course, on inflation?
You know, the RBI must mention the changed global circumstances now, because I think the global recovery is well on its way. There are very clear signs across the Americas, the Euro area, and Japan, etc., that you will get higher inflation and perhaps higher growth now. So that was probably what is beginning to assist the India export story already, and this export story I think is going to be sustained. Is not a flash in the pan. So that they should refer to that. But at the same time, they should also make very clear, if they do get into any standing deposit facility, etc., as to what is their aim and objective of sucking in liquidity at this point of time in the country. They must make that very clear, because just bringing the policy stance and the liquidity situation in sync with each other can be done both ways. And this is what I have been emphasizing. So just to say that because your stance is different from the situation on the ground is not enough. They must say that they are sucking in liquidity because they fear that there is inflation spike will be, or there is asset price inflation, etc., etc. And that is the thing that they should address at this point of time. And finally, I think they must address the NPA situation one way or the other, because that is the way forward for a pickup in the flow of commercial bank credit to the industry. And if that doesn't happen, growth will not happen. And that is the signal that RBI should be giving, that they are getting the NPA into their situation into their hand. And if possibly they can announce something there, that will be a very big move as far as I am concerned.
All right. Thank you very, very much indeed, gentlemen and lady, for joining us right here on this very special show. It's the Credit Policy Countdown. Mythili Bhusnurmath, Arvind Virmani, Dr. Rajiv Kumar and Jahangir Aziz joining us all the way from Singapore. Thanks very much indeed for sparing time and being with us. Within hours from now, Ujit Patel is going to be announcing the next monetary policy. Many people believe it's going to be status quo as far as rates is concerned. But his big concern will be liquidity, which is at variance with his policy stance, which is neutral, and the system is flush with liquidity, but perhaps on account of the large cash deposits that have happened and withdrawals have not been in cognizance. Thank you very much, viewers, for tuning in. Keep it with ET Now for news, views and analysis that matters.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.